the crisis below our healthcare system capacity. In terms of thinking about the economics of this, one way of thinking about it is in terms of flattening the recession curve. So you can think of a quite severe recession if you don't take any macroeconomic policy measures, but perhaps we can help flatten the curve by implementing appropriate macroeconomic policies. So that's another way of flattening the curve, reducing the severity of the recession, providing relief to households and businesses. By the way, feel free to interrupt with questions at any time. I don't mind that at all. So macroeconomists generally classify policy responses into two categories. You have fiscal and you have monetary. So fiscal policy is focused on government spending and taxes. So during a recession, typically we're looking at expansionary fiscal policy, increasing government spending. During a time such as this, healthcare sector is obviously a prime target for increased fiscal expenditure. And on the other side, you have lower taxes, perhaps complemented by greater direct payments to households. So directly supporting households. In terms of monetary policy, that's where we're talking about interest rates and the overall liquidity in the financial system. So I'll talk about both expansionary fiscal policy and expansionary monetary policy as responses to this crisis. It's sort of an interesting third issue here. I mean, normally we think of public health policy as being somewhat separate from economic policy. But I think a lot of the current tensions in our public discourse really are about how these two are entwined. So, across the country, we started with largely indiscriminate stay-at-home orders, and those clearly have devastating effects across the economy. Since many businesses are reliant on in-person workers, Zoom work isn't as easy for some sectors as others. Plus, it puts a damper on consumer confidence and consumers and businesses' willingness to spend, to invest in the future. So you have businesses laying off workers, you have jobless claims soaring. So a lot of what's at issue now, as we discuss how and when to reopen, is an issue that economists think we should have been talking about probably a lot earlier. You can think of it as a hammer versus scalpel issue. So the hammer is the blunt approach, the indiscriminate stay-at-home order. The scalpel issue would be a much more targeted approach, probably involving a lot more testing, testing, isolation, tracing, things like that. So you have a huge tension there, but they're also related in a positive way in the sense that consumer and business confidence, the things that will truly sustain uh, economic growth going forward, those won't really recover until the public feels more confident that the pandemic is better managed, that they can largely go out and interact with the economy largely as they used to, but perhaps still with appropriate social distancing measures. Uh, and there's a lot of hope for a vaccine, but that still seems really uncertain at this point. I don't see how we can rely on that solely.
Mark, in your first slide, you talk about flattening the recession curve.
Yeah.
And so, are we? That's already happening right now, right? The recession is already occurring.
Oh yeah, we're definitely in a major recession. I don't think there's really any question about that. They only officially define it sort of with a lag after the fact. There's a group at the National Bureau of Economic Research that does that. But there's no question that we are. It's just a question of identifying exactly when it started, exactly when it ends. I'll give you a little data on that too. A lot of people define a recession as 2 quarters of negative GDP growth. So in the first quarter here, real GDP fell 4.8%, which is substantial in and of itself. That's quite a big fall. But even with the expansionary fiscal and monetary policies that the US has already undertaken, economists are projecting real GDP to fall 20 to 40% in the second quarter. A lot of the estimates sort of cluster around the middle of that, around 30%. And that's just almost an unimaginable shock to economic activity. It just creates such a deep trench. Once you've gone that far down, even if the economy grows relatively quickly, say it grows 10% in both the third and fourth quarters, we still won't be back to real GDP at the beginning of the year. And that kind of growth still seems very unlikely. So there's this whole issue about are we going to have an L-shaped recession, a long recession, or are we going to have a V-shaped recession? Is the economy going to bounce right back? And what I'm seeing among economic forecasters is that most are fairly pessimistic at this point. I mean, the economy should start to grow in the third quarter. I mean, it almost has to, coming from that deep a trough. But the point is that the growth needed at that point, just to get us back to where we were, is so substantial, much less to make up for lost time. So the L-shaped recession is looking more likely moving forward here.
Mark, what is the L shape? Does that mean?
So that means, you have a deep fall in GDP, and then it's only slowly coming back. So it looks more like an L, as opposed to rapidly coming back, in which case it would look like a V. And you can also look at this, of course, in terms of job market. The unemployment rate hit 14.7% in April, which is probably a substantial underestimate of the true problem, because the definition of unemployment that's used is that workers have to be actively searching for work. Well, in this environment, I mean, a lot of people have just given up searching for work altogether, until they see some kind of signal that the economy is turning around again. And a lot of economists think the unemployment rate will rise above 20%. That includes very prominent people at the Federal Reserve. And that's a truly staggering number. I mean, the Great Depression peak was around 25%. So we're talking truly historic levels. I mean, we really are living through history here. And jobless claims might be an even better way to look at it, because of the problems with the unemployment rate in terms of a lot of workers just having given up looking for work. So I downloaded a couple of graphs here. Here's the unemployment rate. I thought for context, I would include the Great Recession. So the Great Recession, that's the shaded bar. So you'll notice unemployment up around 10% toward the peak there. So you have to look closely. But here we are in 2020 with unemployment close to 15%. And just to see it spike up like that, I mean, it's just truly remarkable to me.
So I have a question.
Sure.
Would you agree that we're in a bull market right now in the stock market? And if so, would this be the first time that we've had a recession and a bull market going on at the same time?
You know, the stock market is interesting. The stock market is not down nearly as much as I would expect it to be based on all that's gone on. I think relative to the start of the year, the stock market is down, what is it? Close to 10%. That's really not so bad given the extent of the crisis we're facing. The stock market actually sort of rallied back from much worse lows earlier in the year. So it's unclear, I think, with the stock market. I think maybe the stock market is overly optimistic at the moment, or I think we'll have to see on that. I'm hesitant to call it a bull market because they seem, I mean, they should be skeptical, but it does seem high to me relative to what we would expect.
Mark,
Yeah.
So just looking at the Dow, it went from 30,000 to 20,000, and now it's back to 25,000.
Right. Yeah, so I mean,
I think the stock market is a reflection of the future, not what it is right now. So I think that's what explains the difference, in my personal opinion.
Yeah, so that's exactly right. The stock market is reflecting investors' perceptions going forward. And I think for a lot of corporations, the sentiment is that they will be able to weather this crisis because they are being given a lot of liquidity, a lot of funding. So the long-term prospects might be good. But I think the stock market seems a little overly rosy personally. But economists aren't very good at predicting that sort of thing. You don't meet many rich economists. So that was the unemployment rate. Here are jobless claims. Again, I thought I'd include the Great Recession to kind of give you some context. I mean, this figure is truly staggering. I mean, you can see we've jumped up. We jumped up to almost 7 million initial jobless claims in a single month recently. And it's come down since then. It's come down to about, 2.5 million there. But keep in mind that even the peak during the Great Recession was less than 800,000. So we're talking about just extraordinary numbers. And that may go on for a while because state unemployment offices, their bureaucracy simply isn't equipped to deal with this level of claims coming in.
Yeah, I have another question, and
Sure.
it deals specifically with federal policies where many people are actually making more money on unemployment than they are if they were working. So some employers are complaining they can't get people back on the job sites because they want their unemployment to expire before they can return to work. Do you have any comments in that area at all?
Yeah, I do think that is perhaps an unfortunate feature of the design. You don't want, I mean, perhaps you want to make the trade-off even for workers, but you really don't want to make it more attractive to stay home. Other than maybe very early on, if you're trying to encourage people, if you're really trying to encourage people not to go to work for the sake of social distancing, if you wanted to shut down the economy in the extremes, that even people who wanted to go to work would stay home. But it seems to me that that's largely counterproductive at this point. People want to go to work, they shouldn't be getting paid more to stay at home, especially with all that we've learned about social distancing and safer practices in the workplace. I would have to agree that that's a concern. So what sort of role do we have for macroeconomic policy here? The general idea is to kind of counteract what may seem like very rational decisions of a lot of individual agents in the economy. Those decisions could lead to sort of a devastating chain reaction. And it starts with stay-at-home orders, consumers cutting back on their spending, firms lay off workers, cut their production, maybe default on loans. Maybe consumers start defaulting on their mortgages, not being able to pay rent. Banks start to experience a rise in non-performing loans. They cut their lending. And you can end up with a further downward economic spiral. So then in addition to a health crisis, you may end up with a financial crisis that has the potential to take the entire economy down. So we're really trying to prevent another Great Depression here. Really, we're trying to keep businesses, households, and the financial system solvent. We want to avoid bankruptcy to a great extent here. And it is a little bit of a delicate task. because you don't want to give loans, for instance, to businesses who should go out of business for various reasons. You want to give loans to businesses that are fundamentally healthy but need some assistance weathering the crisis. And so distinguishing between those two, I think, is the toughest issue here, and perhaps one that all this legislation did very little to address, really. So I'll talk a bit about that. The primary fiscal legislation passed was the Coronavirus Aid, Relief, and Economic Security, or CARES Act. It's $200. That's about 10% of GDP. That's really unprecedented. If you want to compare it to the Great Recession stimulus package, that was less than half, only $830 billion. And there have been some other legislative acts too. So total relief and stimulus is actually more than that. I think one of the sort of unusual features, which ended up being quite popular, was the direct payments to households. Usually politicians go for sort of regular tax cuts, something like that. I think there was a recognition that households needed really immediate relief to pay rent, buy food, that sort of thing. So I think that part of it was quite successful. Here's a breakdown of where the money went. The biggest part was actually corporate loans, interestingly enough. So these are corporate loans, somewhat subsidized by the government, backed by the Treasury. And you can see it's the biggest piece of the pie here. Like I said, the problem there is who should get them, who shouldn't, how do you make sure that loans are being used to truly help worthy businesses weather the crisis, keep people employed, and come out the other end healthy, rather than being misused, squandered, that sort of thing. I'll talk about small business loans in a minute. We talked a little bit about unemployment insurance. I'll talk about some of that. And, you'll notice the hospitals and vets care. A lot of that's being left to states, so that's why you see aid to states a little higher there. Airlines are, of course, expected to need a huge bailout. I think they may well end up looking more like a public utility if this goes on too much longer. So those small business loans were part of the CARES Act, called the Paycheck Protection Program. I mean, I didn't quite realize this, but really about half of small business owners say their business can only survive 3 months or less in this sort of environment. You really have a tremendous number of small businesses just teetering on the brink. And if they have a bad couple of months, that's really it for them. So the idea with PPP was actually to create forgivable loans. Forgivable if the businesses were to largely maintain their payrolls. And it was an initial allocation of 350 billion, which seems like a lot, but it was used up almost instantaneously, it seemed. So they did a second round, 320 billion, and that seems to have satisfied a lot of the demand. A friend of mine, a small business owner in Portland, he applied. It was a lot of hassle. It was a very long process. But apparently it does essentially work. We talked about some of the unemployment benefit extensions through the CARES Act. So state unemployment benefits extended by 13 weeks. You have those increased compensation levels. They can be increased by up to $600. So it is possible for people to make more on unemployment than they did at their jobs, as we noted. And they also increased the eligibility. So independent contractors, which we now have a lot of in the so-called gig economy, they're now eligible too. They weren't before. Let's see, I'll talk a bit about monetary policy and the Fed. So the Fed's typical policy instrument is the short-term interest rate. The Fed took that interest rate to near zero. The goal there is to ease borrowing costs for businesses and for households. So, but once you reach that sort of zero lower bound, that ceases to have much effectiveness. Plus, interest rates were not particularly high to begin with before the crisis hit. So what does the Fed do then? It does what's called quantitative easing, which is just purchasing massive amounts of securities. That's what quantitative easing looks like. So the Fed also did this during the Great Recession. So this is just Fed's assets. How does the Fed put money into the economy? The Fed buys up assets. So to give you an idea, before the Great Recession, the Fed had about $1 trillion in assets. You can see it got up over 4 trillion. Then they started to wind it down a bit. Then the economy started to soften toward the end of 2019. They lowered interest rates a bit. Finally, in 2020, you can see the Fed's assets just shoot up. And that's the quantitative easing. That's the quantitative easing. I mean, so we're talking about, not quite, but almost doubling the Fed's assets in a very short period of time, which is quite a remarkable thing. So that provides liquidity to the financial system. The Fed has even created a whole bunch of new lending facilities to keep the financial system going, and even to help out corporations and mid-sized businesses left out of that PPP program. Fed's really doing unprecedented sort of things. And the chair said that the Fed still has a lot of firepower. So we're potentially not even close to done yet.
When he says lots of firepower, what does that actually mean? What can he do in addition to what they've already done?
The main thing is just to keep purchasing more assets, bringing longer term interest rates even further down. providing more liquidity to firms and banks. It's even been floated. I don't know if this is a particularly good idea, but one sort of extreme idea is we normally think of there as being a zero lower bound on interest rates. There is a thought that we could even go to negative interest rates. So in other words, you would have to start paying your bank for the privilege of having your money safe there. And banks would in turn pay the Federal Reserve for the privilege of keeping their reserves there. And I'm not sure that's such a great idea. I think it maybe not that. But in terms of firepower, the Fed has enormous ability to buy up assets. And in fact, Fed Chair Jay Powell recently talked about that Congress should do more fiscal stimulus. And I think he implicitly means that if Congress does that, that the Federal Reserve will happily buy up that debt, essentially. I think the Fed Chair is acutely aware of the potential for things to spiral out of control if we don't really keep the financial system healthy here.
What are your thoughts on mortgage defaults? It seems to me that people without jobs can't pay their mortgages. People who have rental properties can't collect rents and therefore pay their mortgages. It seems like we're going to have a major situation on the horizon where we're going to have a lot of defaults.
Yeah, I think some of the measures so far have helped, but what they're doing is really, it's just forbearance. So you're allowed to not pay your mortgage for a while without penalty, but it's not relieving you of the burden of your mortgage. You're just kicking the can down the road, so to speak. So banks are willing to work with their customers, but it's not like there's been loan forgiveness at this point. And I think it'll be interesting to see how that evolves. Banks do too much, we will see some further legislation because if as we saw in 2007, 2008, when mortgage defaults rise, that has the potential to bring down the entire financial system, really. And then one other thing I wanted to mention is just we got to keep in mind state and local governments. I was reading an article that Washington State alone is estimated to lose $7 billion due to this crisis. And state governments are required to balance the budget. The federal government has no such requirement. So, the federal government could still be doing stimulus, but if all the states are severely cutting back to balance their budgets, that's going to be a complete drag on the economy. On net, it might even be that we have contractionary fiscal policy once you take into account state and local government. So something needs to be done there. Or I think that in particular will really prolong the recession. And of course, that leads into the longer term concern, which is what are we going to do about the national debt? Which doesn't seem to be a huge problem for the US. We seem to be in a very lucky position in the world right now. The rest of the world loves to hold our debt, particularly during a crisis. We've been enjoying historically low interest rates for a very long time. So the burden of our debt, even though the debt itself is large, the interest rate burden is not all that substantial. So the US is in a relatively safe position there still. A lot of smaller developing countries could be on the brink of sovereign default. So those are some of my thoughts. I'm happy to take further questions.
Go ahead. Anybody has questions, and then why don't we have Mark take your presentation off screen, and then we can see everybody a little better. That'd be helpful.
Sure.